Welcome to my video. This is Kevin. Today I want to share with you one of Warren Buffett's favorite metric to determine return on investment on a particular company. And I'll also go through an exercise with you on how to derive that. It is called the owner's earning. What exactly is an owner's earning? It is essentially the amount of cash you can take home if you were to own 100% of the company. Let's take a look on how to retrieve that. So owner's earnings is equal to net income plus amortization plus depreciation plus asset impairment charge minus the capital expenditure in your financial statement. Why is this number important? It's important because it gives you a sense of how much profit you will make annually for every dollar you invest in the business each year. Let's take a look at each of the numbers individually in this formula and see what they are. First is the net income. This one is more intuitive. It is what the business has left after all expenses are paid, including salary, wages, cost of goods, material, and taxes. However, this does not necessarily equal to the amount of cash that you can take home because some of the numbers included in net income are non-cash related. They're solely for tax purposes, so we'll need to add those back in order to get the owner's earnings. I'll be talking about a few of them next. Amortization is the practice of spreading an intangible asset's costs over that asset's useful lifetime. Intangible assets are not physical assets. Examples of intangible assets that are expensed through amortization might include licenses, patents and trademarks, franchise agreements, and many others. In this case, let's use license as an example. Let's say your company spends like $50,000 to obtain a license, and the license in question will expire in 10 years. You will be able to amortize it for the 10-year period. Assuming you use the straight line method of amortization, which is a method for charging a cost to an expense at a consistent rate over time. The company's actual amortization expense for the license will be $5,000. That's $50,000 divided by 10 years. So that gives you $5,000, meaning the asset will decline in value by $5,000 every year, and you can deduct that in your tax return. Depreciation is a method of spreading the cost of an tangible asset over a specific period of time, typically the asset's useful life. For example, let's say your company purchased a new piece of equipment with an estimated useful life of 10 years for the price of $100,000. Using the straight line method, the company's annual depreciation expense for the equipment will be $10,000. You get this by dividing $100,000 by 10 years. Asset impairment charge. An impaired asset is an asset that has a market value less than the value listed on the company's balance sheet. Let's say that a company currently owns a property and that property is valued at $100,000 on its balance sheet. And then fast forward to next year, a housing recession hits, and now the value of the same property has dropped down to $80,000. In this case, the property has gone down by $20,000 in value. You will be able to record this as a $20,000 loss as an asset impairment charge in your tax return. As you can see, amortization, depreciation, and asset impairment charges are non-cash related expenses. Therefore, we will need to add these back to get owner's earning. The next is capital expenditure. What exactly is capital expenditure? These are the funds used by a company to acquire, upgrade, and maintain physical assets such as property plants, buildings, technologies, or equipments. For example, if you own a multi-family residential property and use it for rental purpose, and every year you have to spend $10,000 to repair the property to keep it in a good shape so people can actually live in there, that $10,000 will be considered as capital expenditure for your business. This is a cash expense, therefore we actually need to subtract it from the net income in order to get the owner's earnings. Now you know what each of the numbers are and how to calculate the owner's earnings. Let's take a look at getting the owner's earnings for Energy Transfer together. All right, let's get the owner's earning for Energy Transfer for 2021. So since we are still at the fourth quarter, we will not have the exact amount of the owner's earning for 2021. We will kind of like have to estimate the Q4. So let's get it anyway. So I always like to go get the financial statement for the company to look at that. You can also use like services such as like Yahoo Finance, but sometimes those are missing out certain things. So the most reliable way is just go to the financial document directly from the company. So you just have to Google it and this thing pops up. You can just go in here. Let's take a look at the most recent one. So this is the third quarter. And now this is the financial statement. And what we want to know is, let's take a look. So owner's earning equals net income plus amortization plus depreciation minus capital expenditure. So first, let's get the net income number. So it's generally here. It's in the income and loss statement. So you can see this is the net income. When it's in parentheses, it means loss. So in this case, for the third month ended in 2021, for the 3 months, it's 907 million. And the 9 months, so now the year to date, it's 5.4 billion. So since this is only up to date for up to Q3, let's make the assumption that, let's assume Q4 will have the same amount of net income as Q3. So let's take a look at what that number will be if we use that assumption. So it's 5456 plus 907. This is 6.36 bill. So let's make a note of that. 6.36. And let's take a look at the amortization. So if you look at the amortization and in the financial document, normally you will see it grouped together with depreciation. So here we have both. Let's take a look at this. So 9 months up to date is 2.8 bill. Let's also make the same assumption that the last quarter will also be the same as the third quarter. So let's make a note of that. So it's 943 plus 3837. This gives us 33.78 bill. Let's take note of that. So this have to be both of these now at this point. So now let's take a look at capital expenditure. So for that, we would just need to search for normally expenditure in here. And then it's usually in the cash flow statement. So you see here the 9 months ending in September 13, Q3 is $371 million. But note this is maintenance capital expenditure, and there's also growth capital expenditure. So let's make a note of that first. Let's assume the fourth quarter maintenance capital expenditure will also be 155. So let's add 155. So 155 plus 371. This will be our number for the 2021 full year maintenance capex, which is 0.526 because I have this in billion. Now let's take a look at the growth. So here in the financial statement, we do expenditure for full. It says over here for full year of 2021, ET expects its adjusted EBITDA to be 12.9 billion to 13.3 billion, and its growth capital expenditure to be approximately 1.6 billion. So let's note that 1.6 bill.
So now let's put that into the formulas equal 3.66 plus 3.78 minus 0.526 minus 6. So let's use a calculator. That's 3.78 minus 1.6. So the owner earnings will be $8 billion. So this basically, if you were to own ET right now, if you own it 100%, you will make this much amount of money. You could put this much amount of cash back to your bank at the end of this year. And so now let's take a look at what is the return on investment rate. So return on investment rate, it's owner's earning divided by market cap. Let's take a look at market cap right now. Let's see. So the market cap, it's 24.09. Let's round it up. So 24.10 billion. If we do the math, the ROI will be oops, let me charge my Mac. So 8.8 divided by 24.10. This is approximately 33%. This is ridiculously high. Like, this is why I haven't bought a lot of ET lately. Normally, I'll be happy with when you get ROI with like 15%, depending on the business. In the sense of like 33%, this means whatever the amount of money you invest in right now, from a business perspective, you will make this capital back within 3 years. Of course, assuming that the coming 2 years will also have like the same revenue or more. So if you get more than, you get your money back at a lower time. So yeah, so this is how you calculate the owner's earning and the return on investment. So I have also put together a few comparisons for owner's earning for 5 different companies in the energy sector. And I would like to share that with you. Let me just enlarge this. So like the first one is OXY. Obviously, for those of you who watched my videos before, you know, like I basically got all my money into these 2 stocks. And I want to share with you on like the rate of return on investment at this point based on the current stock price. Let's take a look at this. So the market cap, I got it like, I think, pre-market. So it might have a little adjustment now, but that's fine. You get the idea. So let's take a look at OXY in comparison to others as well. So OXY, at this current net income, cap X, the current market cap, I'm basically getting 23% rate of investment, return on investment, basically just by investing in this right now. Basically, if basically for every dollar that I invest in, this business will be able to earn me back 23 cents each year. Of course, the coming year it might be better depending on like the oil price, since the business of OXY is heavily dependent on the WTI oil price. But we'll see. I'm pretty confident that it will stay at least above 60. So I think I'll be happy with this. Although even if it dropped by a few percentage, I'm still happy. So the second one is ET. Like ET, like this is tremendous amount of return right now. If you were to invest in energy transfer, like it's killing basically every other one that I have analyzed. So it's right now it's sitting at 32.47%. Another way of seeing this is assuming the coming year, like the demand and the energy business, if it stays the same, then you will basically get all of your money back in 3 years by investing into this business at this point. And so the other 3, like CVX, this is 14%, which is still reasonable at this point for me. But like this ExxonMobil 4%, I wouldn't go into that. Like COP, I wouldn't go into that. Just by looking at this, I think the top 3 is way better. But I think now, like if I have more money at this point, I would definitely go into ET. So yeah, anyway.
This is all I have for today. Please comment below if you have any questions or topics on what you want me to cover in my future videos. Don't forget to like the video using the like button below if you like the content. Subscribe if you haven't done so you won't miss my future videos. I will also start to publish a daily snapshot of my portfolio on my Twitter account every evening from Monday to Friday. Don't forget to follow me on Twitter if you're interested. My Twitter link is below in the description. Thank you and have a great day.